Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first, OpenAI's $38 billion AWS deal disrupts its Microsoft alliance, fueling a multi-cloud arms race for scarce GPUs. So we'll discuss why this strategic pivot intensifies the AI infrastructure battle and what it means for Silicon Valley's power dynamics. Second, Norway's $2 trillion fund rejects Elon Musk's massive Tesla pay package, citing key person risk and corporate governance concerns. We'll analyse why this rejection is a turning point and how it could affect competitive dynamics between institutional and retail investors. Third, Palantir's commercial business quadruples as its AIP platform upends the enterprise market, defying high valuation concerns from analysts. We'll examine how its operational AI strategy may impact the innovation cycles for legacy software vendors. Fourth, US all-electric vehicle sales collapse after a $7,500 tax credit ends, while hybrid vehicle sales surge by over 40%. We'll explore how this market reset could transform automakers' product roadmaps and impact the global EV supply chain. Fifth, Nintendo's profit skyrockets 270% with 10 million Switch 2 sales, revealing a breakthrough in supply chain strategy. In this episode, we'll break down this winning formula and what it signals for the entire console ecosystem. The story begins with a decision that caught everyone by surprise. OpenAI, the company that brought you ChatGPT almost exclusively through its partnership with Microsoft, just signed a massive deal with Microsoft's biggest rival. A while back, we said OpenAI was already hedging Microsoft, even formally listed OpenAI as a competitor, while OpenAI shed Microsoft's right of first refusal and lined up multi-$100 billion Azure capacity. Well, the latest development is this. The hedge just turned into a full-on multi-cloud play. So the thing is, this isn't just about switching teams. This is a strategic pivot toward what's known as a multi-cloud approach. The goal is to reduce the massive risk of relying on a single provider and to secure access to the scarcest resource in tech right now. Powerful GPUs, the specialized chips that AI models need to think. As we discussed a while back, this is the arms race measured in megawatts, not headlines. Whoever controls capacity and trust wins. Let's put a number on it that might just change your perspective. A $38 billion 7-year contract with Amazon Web Services. This move is a clear shot across the bow, designed to reduce OpenAI's reliance on Microsoft and secure its own future. Think Apple and Samsung's co-opetition. Partners, suppliers, and rivals often all at once. We've been tracking that exact dynamic between Microsoft and OpenAI. This makes it explicit. What made this possible was OpenAI's recent restructuring. It's now a public benefit corporation, which gave it far more operational autonomy, freeing it from the kind of exclusive agreements that might have tied it to Microsoft indefinitely. It's a declaration of independence, and it also sharpens the philosophical split we talked about before. Microsoft is leaning into safe, reliable AI as a tool for enterprises, while OpenAI, led by Sam Altman, keeps pushing toward AGI. Today's deal widens that lane for both. And that $38 billion is just the beginning. In 2025 alone, OpenAI has signed deals worth more than $1 trillion with giants like Oracle, AMD, and NVIDIA. Continuing our last discussion about colossal capacity commitments, remember that $250 billion Azure capacity and the megawatt race. This is OpenAI doubling down on the same playbook, secure everything you can, everywhere you can. But what is computing power, really? It's not just about buying more chips. The real challenge is overcoming massive technical bottlenecks. We're talking about the speed of the connections between the chips, the data storage systems, and the incredible amount of electricity needed to run it all. This is why a deal with a specific provider like AWS is so critical. They offer specialized hardware and infrastructure designed to overcome these very problems, giving OpenAI an edge that goes far beyond just the number of processors. As we noted before, this is infrastructure ideology as much as hardware, control throughput, energy, networking, and you control the game. This all follows a sweeping restructure at OpenAI, loosening its ties with Microsoft and giving it more operational and financial freedom. It seems that freedom is being used to play the field. Meanwhile, Microsoft has been preparing for this reality, positioning itself as a neutral aggregation layer for models and as a platform governor. We talked about how they're building sovereign scale capacity in places like the UAE, acting as a trusted wrap around advanced AI to satisfy governments and regulators. However, if you zoom out, you'll see another layer of strategy at play. While OpenAI is spending at an unheard of rate, it's also losing money at a jaw-dropping pace. Quarterly results from Microsoft indicated that OpenAI lost $12 billion in just the last quarter. We've said before, capacity-first strategy means burn now, dominate later. This is that thesis on steroids. So how can a company lose that much money but commit to spending trillions? Actually, these massive cloud deals aren't like writing a check for a new car. They are structured as complex long-term commitments, often with payments phased over many years, allowing OpenAI to access vast computing resources now while managing the costs over time. It's a high-stakes bet on future growth. The market, however, is placing its bets. After the deal was announced, Amazon shares hit an all-time high, adding $140 billion to its valuation. This concentration of power is, raising major alarms. Regulators like the US Federal Trade Commission have already launched inquiries into these partnerships. The concern is that these deals are creating a compute cartel, an oligopoly, where a handful of cloud giants and AI labs control the essential infrastructure for the future of technology, potentially boxing out smaller competitors. We previously analysed Microsoft's shift from partner to platform governor. That's exactly the kind of consolidation and gatekeeping regulators are watching. And globally, the sovereign AI push we discussed from Europe to the Gulf reflects a desire to avoid dependence on any single stack, even as American hyperscalers offer that trusted wrapper as the price of access. This tangled web of deals has experts warning of a potential AI bubble, but when confronted with the unprecedented level of investment, OpenAI's CEO, Sam Altman, had a direct response, noting that while the spending is historic, it's also unprecedented for companies to be growing revenue this fast. In other words, the co-opetition we flagged a while back, Microsoft courting the cautious enterprise, OpenAI chasing the AGI frontier, and AWS supplying raw power just entered its next phase. We just talked about a massive power play in the AI world. And speaking of high-stakes corporate drama, our next story involves a $2 trillion fund telling Elon Musk his nearly $1 trillion pay package is a no-go. Now, to understand the gravity of this, you need to know who we're talking about. This is a sovereign wealth fund. It's essentially the entire country of Norway's savings account built from its oil and gas revenues. Their goal isn't just to make money, but to invest ethically and responsibly for the long-term future of their citizens. So when they speak, it carries immense moral and financial weight. Norway's sovereign wealth fund, one of the largest and most influential investors in the world, just announced it's voting against Musk's massive compensation plan at Tesla. This comes despite threats from Musk himself that he could step down if the deal gets rejected, setting up a massive power struggle. The fund, Norges Bank Investment Management, holds an $11.6 billion stake in Tesla and is drawing a line in the sand. In a public statement, it cited major concerns over the sheer size of the award, its dilutive effect on other shareholders, and the immense risk of tying the company's fate so tightly to one key person. And here's where it gets interesting. The fund's key person risk argument is a paradox. They're saying that a pay package designed to keep Elon Musk at Tesla is the very thing that highlights the massive risk of the company, depending entirely on him. Standard procedure in a big company is to have succession plans and delegate power, but those strategies break down with a figure like Musk, who is seen as the living embodiment of the company's vision. So the move to lock him in actually exposes the company's biggest vulnerability. What really brought this to a head was Musk's reaction. He has already labelled other firms advising against the deal as corporate terrorists. This is a wild move because the firms he's targeting, like ISS and Glass Lewis, are what you call proxy advisors. Their entire business is to research issues like this and advise giant institutional investors on how to vote, and their influence is huge. Research shows that a negative recommendation from a firm like ISS can slash shareholder support for a CEO's pay plan by as much as 25 percentage points. Musk isn't just angry. He's fighting an entire industry designed to keep executive power in check. And this isn't his first clash with the Norwegian fund. After a previous disagreement over his pay, Musk reportedly sent a stunning text message to the fund's CEO saying, "When I ask you for a favor, which I very rarely do, and you decline, then you should not ask me for one until you've done something to make amends." Friends are as friends do. This is a direct challenge from a global financial titan. Musk has already put his position on the line, previously posting on X in response to critics, which of those CEOs would you like to run Tesla? It won't be me. This whole situation presents a fascinating duality in modern investing. On one side, you have institutional investors like Norway's fund focused on governance, risk, and long-term stability. On the other, you have a huge number of passionate retail investors who see this as a rational bet. Without Musk, the company is worth far less. This is a new kind of fan-based investing that often defies traditional financial logic, and it's a powerful force. This isn't just a vote on a paycheck. It's a high-stakes battle of wills between the world's wealthiest person and one of the world's largest pools of capital, with the future leadership of Tesla hanging in the balance. From one outspoken CEO clashing with investors, we turn to another who's taking on market skeptics with a vengeance. Palantir's CEO just went on the record calling the company's detractors deranged and in a state of self-destructive befuddlement. And if you look at their latest numbers, you might understand why. A while back, we talked about the political fireworks inside Palantir. Today, that same combative energy is aimed squarely at market skeptics as the numbers roll in. Palantir just crushed its earnings, reporting revenues of $1.18 billion when only $1.09 billion was expected. But that's not the real story. The company's US commercial business more than doubled, and the total value of its new commercial deals, it more than quadrupled to a staggering $1.31 billion. Continuing our last discussion about Palantir's government tilt, the focus this time is different. The commercial engine is taking the wheel. So what's driving this commercial explosion? For years, Palantir was known for building custom, high-end software for government spy agencies. Now, they've successfully packaged that power into a commercial product called the Artificial Intelligence Platform, or AIP. The reason this is a game changer is their unique approach. While competitors focus on raw data processing, Palantir uses what's called an ontology. It basically creates a digital twin of an entire organization, modeling data as real-world objects like customers and suppliers. This allows business users, not just data scientists, to use AI to make real-time operational decisions. This isn't a fluke. The stock has already surged over 170% this year, pushing its market cap past $490 billion. While analysts raise concerns about its extreme valuation, Palantir is steadily beating out legacy government contractors. As we noted a while back when it landed a deal worth up to $10 billion with the US Army. Now, those analyst concerns do have some teeth. Palantir's valuation is sky high, with a price-to-sales ratio of 25, nearly 12 times the software sector's median. It suggests investors are betting on a future where Palantir faces almost no competition. But the reason the Army deal is so significant is that it shows why Palantir is different. Their software is so deeply embedded in essential intelligence and defense operations that it's seen as shutdown-proof, ensuring demand continues regardless of what's happening in Washington. And remember, we talked about Palantir making a high-risk political bet. The new wrinkle is that this commercial surge starts to reduce that concentration risk. In a letter to shareholders, CEO Alex Karp didn't mince words. He said, Palantir has made it possible for retail investors to achieve rates of return previously limited to the most successful venture capitalists in Palo Alto. For a company we previously described as paying an alignment tax, internally, that's a notable contrast. Messy politics, clean execution. The company is riding a tidal wave of demand for its artificial intelligence platform, announcing new partnerships with tech giants like Snowflake and NVIDIA. Believe it or not, Palantir's AIP was recently ranked by Forrester Research as the #1 AI and machine learning platform, even beating out giants like Microsoft and Alphabet. A few days ago, we framed Palantir's story through the lens of government and ideology. Today, the focus shifts to broad-based cross-industry adoption. As Karp stated in a recent interview, there's a lot of excess in the AI market, and some companies are going to feel the pain. His final word on the matter is the most telling. The strong companies are going to get much stronger, and the people pretending they're doing stuff are going to disappear very quickly. When Karp says pretending, he's pointing to a key difference. Many companies are just building chatbot models. Palantir, on the other hand, is focused on operational AI. Their platform is designed to embed AI directly into a company's most critical workflows, with built-in security, governance, and a human-in-the-loop model. This means a person has to give explicit approval for high-impact decisions. We previously noted Palantir's roots in government surveillance. The update is how that same governance, first DNA, is being productized for mainstream businesses through AIP. This focus on secure, practical, and audited AI is the moat they believe will protect them when the AI hype bubble eventually pops. Palantir's success is a story of a strategic bet paying off. But in the auto industry, a very different kind of bet, the all-in push for electric vehicles, is facing a brutal reality check. Sales of all electric vehicles just collapsed after the government pulled the plug on a massive $7,500 tax credit. And, this isn't just an American story. We're seeing this play out across the globe. When Germany abruptly cut its EV incentives, for example, new car registrations plunged by 23%. This shows just how sensitive the early EV market is to government support. That $7,500 credit wasn't just a discount. For many buyers, it was the entire reason they could afford to make the switch. The fallout is staggering. Ford, a top 3 EV seller, saw its all-electric sales drop 25% year over year. But for competitors Hyundai and Kia, the numbers are catastrophic. Their top EV models plunged between 52% and 71%. And if you think that's bad, the month-to-month drop is even worse. Hyundai's Ioniq 5 and Ioniq 9 models saw sales crash by 80% and 71%, respectively, from September to October alone. You might be wondering about the market leaders, Tesla and General Motors. Well, they weren't immune. In that same period, Tesla saw significant sales drops in key European and Chinese markets after subsidies changed. And General Motors, they responded to the declining demand by announcing layoffs for about 1,700 workers. This proves that even the strongest brand loyalty can't completely shield a company from a major policy shock. But that's not the whole picture. Take Toyota, for instance. A year ago, it sold over 1,400 units of its all-electric BZ vehicle. This past October, it sold just 18. This highlights a massive strategic gamble that is now playing out in real time. While some automakers went all in on pure electric, others, like Toyota, kept a strong focus on a different technology. So what's happening here? While the pure EV market was cratering, another category was quietly exploding. Hyundai reported its hybrid vehicle sales surged 41% in October. The push for electrification isn't over. It's just dramatically shifting lanes from all electric to hybrid. For the automakers, this shift brings both opportunities and significant risks. The truth is, hybrids are incredibly profitable. Hyundai has reported that their profit margins on hybrids now match or even beat their traditional gasoline cars, whereas many pure EVs are still sold at a loss. So for an automaker, selling a hybrid is good for the bottom line and still moves them toward electrification. By mid-2024, hybrids made up a staggering 37% of Toyota's total sales. They played the long game, and right now, it's paying off. Industry leaders are now calling this a massive market reset. Ford CEO Jim Farley went on the record predicting that after the credits ended, the EV market share could get cut in half, falling from a high of around 12% down to just 5%. And the ripple effects go way beyond car dealerships. Think about the massive supply chain built around the promise of explosive EV growth. Battery manufacturers like Samsung SDI and LG Energy Solution have reported huge operating losses as orders dry up. The entire ecosystem, built on the assumption of subsidy-driven demand, is now feeling this shock. One executive from Hyundai admitted that while they saw strong demand before the change, they are now confident the market is going to reset. An expert at Edmunds has the final word on what this all means, stating the market is now entering a new era, one defined less by incentive-driven urgency and more by buyers with genuine interest in owning an EV. So who is this genuine interest buyer? Research suggests this is a consumer who can look past the higher sticker price because they've done the math on the total cost of ownership. Even without the tax credit, one study found that nearly half of all EV models are still cheaper to own over 5 years than a comparable gas car. Once you factor in fuel and maintenance savings, ultimately, this suggests the market might be splitting. We could see EVs becoming a premium product for more affluent buyers who value the technology and long-term savings, while hybrids capture the pragmatic middle-class driver looking for efficiency without the high upfront cost. The era of easy money is over, and we are now seeing the true unfiltered demand for all-electric cars. While the EV market grapples with a painful reset, our final story is about a company that just engineered one of the most successful product launches in recent memory. Nintendo's profit just skyrocketed more than 270%. This massive surge is being fueled by one thing: the runaway success of its new Switch 2 console. Since launching in June, Nintendo has already sold a staggering 10.36 million units. The demand is so strong, the gaming giant just raised its sales forecast for the fiscal year from an already ambitious 15 million units to a massive 19 million. Now, get this. To appreciate how incredible that number is, you have to look at their competitors. Companies like Sony and Microsoft had disastrous launches for their last consoles because they couldn't get the parts. So how did Nintendo plan to make 19 million units? The answer is supply chain mastery. They made a strategic deal with Samsung to manufacture their custom-designed NVIDIA chips. By using a specific 8nm process, they found the perfect balance between performance and, most importantly, availability. They secured their supply chain years in advance, completely avoiding the shortages that crippled everyone else. It was a masterclass in planning, but if that was just the appetizer, the main course is just being served. Revenue is up over 90%, and the company's stock has climbed nearly 40% this year. This all happened despite major questions swirling over whether the Switch 2 could possibly live up to the hype of its legendary predecessor. This is where the situation takes a more complex turn. The original Switch was revolutionary, so the sequel had to be more than just a little better. Nintendo delivered. They made the screen bigger and crisper, a 7.9-inch Full HD display. They completely redesigned the Joy-Con controllers for better ergonomics, but the real game changer is backward compatibility. The Switch 2 plays almost all of your old physical and digital Switch games, which means the 10 million people who upgraded didn't have to leave their game libraries behind. This is a huge reason for its success. So what's their secret playbook? It's leaning hard into their blockbuster franchises. The same strategy that made the original Switch a cultural phenomenon. Smash hits like Mario Kart World and Donkey Kong Bonanza are flying off the shelves, helping the company sell nearly 12 million games for the new console in just one quarter. Interestingly enough, this wasn't just business as usual. This was a new, far more aggressive playbook. When the original Switch came out, it launched with basically one killer app, The Legend of Zelda. For the Switch 2, Nintendo unleashed a full-scale assault, dropping huge titles from multiple major franchises all at once. It was a first-party launch blitz designed to give every new owner an incredible library of games from day one. The company is now replicating that strategy, bundling the console with new titles like Pokemon Legends ZA to keep the momentum going into the critical holiday season. Nintendo isn't just riding a wave, they are creating it. By dramatically raising their sales forecast and hiking their overall net profit outlook by nearly 17%, the company is sending a clear message. They have silenced the doubters and proven their formula for market dominance is stronger than ever.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.